Bhavesh.
Hi, hi Ankit.
Yeah, so I'll start with your introduction, Bhavesh. Bhavesh is with Edelweiss Asset Management since January 2008, and he's a veteran of the industry, having more than 15 years experience, rather 16 now. And Bhavesh manages Edelweiss Aggressive Hybrid Fund, Balanced Advantage Fund, and Equity Saving Fund, and Large Cap also. So in total, he manages four funds from large cap and hybrid categories. So welcome, Bhavesh.
Hi Ankit. Uh, Good morning to all your viewers.
Thank you. It's pleasure hosting you. So Bhavesh, starting with the budget, there used to be a time when budget used to be a very big bang kind of event. But in recent years, we have seen that government no more wait for budget to publish their major policy issues. So do you think all the, hype around the budget has come down in recent years?
I think this is the way it actually should have been always. People used to wait for budget because historically a lot of big bang reforms or taxation changes was always announced in budget, and that's why you will see historically January February has been the most volatile month for our markets because sudden change in taxation, sudden change in dividend policy, long-term capital gain tax, etc., which was introduced in budget. Uh, Lead to unwanted volatility in market. Now, this government, you will see they announced all the major changes, like corporate tax cut was also announced in September and not in budget. This was just a statement of account because full-fledged budget will be announced post-election in the month of July. The expectation was on the lower side, but I think the government made sure that that hype, or you can say glamour around budget goes down, and people treat it like a normal event. And I think this is a good step because this would you can say at least that speculation and that unwanted volatility around budget will go down drastically. I think this is a positive step. Again, whatever statement of account was announced, the limited you can say budget which was given, it has been taken very well, at least for the bond market. This was a budget for the bond market wherein numbers on fiscal deficit, borrowings, etc., has surprised everyone positively, and the reaction is quite visible. If you will see the 10-year G-Sec have moved from almost 715 720 to levels of almost 7.5 7.05. So I think bond market will take it in a positive way. I think for equity, any negative news is not there, that itself is a positive trigger for us.
Yeah, so you mentioned about fiscal prudence, how fiscal prudence has helped in bringing down the yields. So my question to you is, was it along the expected lines, because we are in an election year, and typically in election years government bring very populist budget. So was it along expected lines, or it was a surprise for the
So
industry?
I think it was a big surprise for you can say most of the market participant because being an election year, if you will see last time during budget in 2019, they announced the scheme of giving you can say 6,000 cash benefits to farmer. This time also expectation was on similar line as we move closer to election. I think some populist scheme definitely was expected, but the government has surprised everyone positively. In fact, you will see mutual funds were seller in bond market for last few days because they were also expecting that because of some populist announcement, yield may hard go up and then they will get an opportunity to deploy at better level. But because of this surprise, where even you will see fiscal deficit pathway for 2025 and 2026 has actually given you can say a big surprise, and that is the result that mutual funds were a big buyer in last couple of days because whatever they have sold in anticipation that yields will go up has taken a U-turn, and now they are buying at this level also because they feel that yield will definitely go down. Now with US interest rate expected to go down, you can say sooner than later, maybe March, maybe May. That is the debate now, but interest rate cut will happen. That is, you can say, more or less factored in into US bond market. But our bond market was still not factoring a rate cut. But I think it is as good as a rate cut. The announcement which has happened in budget, particularly on the fiscal deficit number and lower borrowing, is as good as a rate cut. And that's why you see our 10 years have given a rally of almost, you can say, 10 to 15 basis point. And we expect this to continue, particularly say in next week when RBI policy will be there. I think we will get a much better clarity at that point of time.
Okay, Bhavesh, for the benefit of our viewers, can you just brief a little bit about how fiscal deficit affects yields and how yields affect your debt holding? Means the negative correlation between the two.
Yes, if you'll see historically, India government has you can say historically government has given a pathway that they will bring fiscal deficit to 4%, 4.5% for quite some time. But because of various event like COVID and other stuff, government was not able to meet their you can say stated target. This time again, the government has you can say surprised everyone. People are expecting the fiscal deficit target will be 5.3, 5.4, but they have gone ahead and given a number of 5.1. Now, if fiscal deficit is managed, fiscal deficit is under control, automatically your interest rate goes down. Your country becomes your economy becomes stronger, your currency becomes stronger, and as a result, even your interest rate goes down, which in a way help a fixed income investor because you will get mark to market gain on whatever duration portfolio you are running. That also means that if you see the corporates are able to borrow at a lower rate, their cost of borrowing goes down. That eventually helps their earning also, and as a result, it is a cyclical effect which happens not only to bondholder but also equity shareholders. Because finally, if interest rate goes down, their cost of borrowing goes down. Automatically, profitability goes up, and accordingly, in line with that, EPS of a particular company goes up, and as a result, you can say stock price also goes up. So it is a win-win situation for economy. It is a win-win situation for equity holder as well as bondholder. The only you can say negative effect will be going forward. Your FD rates will go down, so those who are, you can say, saver, for them, FD rates can go down, which can have a negative impact on at least the saver community. But I think it is a you can say trade-off between those who want to save in FD versus those who want to participate in equity. So I think in the long term, I think equity holders or shareholders will be in a position to get better returns compared to an you can say fixed income investor. So one should definitely try to take this kind of situation in their favor by participating in you can say some of other products which are like say for example a lot of hybrid funds which are a winner in both the situation. When debt interest rate goes down, they make profit from that side also, and when equity market goes up, they make profit from this you can say equity side also. So I think this is a situation where hybrid funds definitely are in a better shape compared to a pure fixed income fund.
So, so what we are, looking at over here is कि if interest rate goes down, then FD people uh, are harmed by lower rates, while those who are in debt funds they benefit. Correct, Bhavish?
Yes, yes, that benefit
And
is for short
and
term. Yeah, that benefit is for short term because whenever there is an interest rate cut, whatever duration you run, you will have some you can say mark to market gains, which will help to jump your return in the short term. But overall reinvestment risk will be there for even a fixed income investor also.
yes, so अगर फिजिकल डेफिसिट कम हुआ है तो गवर्नमेंट कम बोरो करेगी, गवर्नमेंट कम बोरो करेगी तो इंटरेस्ट रेट कम होंगे क्योंकि डिमांड कम होगी, और इंटरेस्ट रेट कम होंगे तो उससे जो मेरा डेट फंड है उस पर एप्रिसिएशन आएगा.
Perfect, perfect.
Great, great. And Bhavesh, you manage hybrid funds. So can you tell us how hybrid funds can help us in all market conditions?
Yep. If you'll see hybrid funds, it starts from zero equity and it goes to as high as you can say 80% equity. Uh, Zero equity is a product like arbitrage fund where we buy equity shares, we sell future, and we hedge this position completely. So though it is an equity taxation product, but actually equity exposure is zero. Whatever position you take in equity is completely hedged. So even if, say for example, I buy Reliance at 1,000 rupees and I sell Reliance future at 1,010, so the gap is 10 rupees. So my profit is 10 rupees. Now, whether Reliance from 1,000 rupees goes to 2,000 or from 1,000 goes to 500, my profit will be fixed. That is 10 rupees. So it is purely a substitute to your traditional fixed income product. Like when we talk about fixed deposit, the interest component is fixed. When we say fixed income fund, the coupon is fixed. Similarly, when we talk about arbitrage fund, your spreads are fixed. And that is why though it is an equity product, equity taxation oriented product, but for practically it is as good as a fixed income product. So that's why we say it is a zero equity product, giving you returns which are closer to short term interest rate in economy. So earlier when liquid
Risk-free
fund,
return. What
yeah,
they call risk-free return.
yes, yes. So it is as good as tax free return and with better taxation because you are getting taxation of equity, which is 15% short term capital gain tax and 10% long term capital gain tax. So this is on zero equity. After that, within hybrid, we have a product known as equity saving fund. where we have 25% directional equity, or you can say naked equity, and remaining 75% is a combination of arbitrage as well as fixed income product. So again, taxation wise, it is an equity product because we have 20%, 25% directional equity and close to 40 to 45% arbitrage. So you qualify for
Bhavesh,
equity taxation. Yeah.
Bhavesh, just a small interjection. If with every category you can tell us a little bit about their historical returns.
Sure. So arbitrage historically, if you will see, when interest rate was around 8-9%, like in 2014-15, when inflation was high and interest rate was high, liquid fund was giving you 8 to 9% return. So at that point of time, arbitrage fund was also giving you 8 to 9% return. Then during COVID, when interest rate saw a sharp decline, that time liquid fund started giving you 4 to 5% return. Arbitrage fund also in line with that started giving you 4 to 5% return. Now, when interest rates have moved up and liquid fund has started giving you 7 to 7.5% return, arbitrage fund are also giving you returns of 7 to 7.5%. So the bottom line is your returns will be in arbitrage fund, your returns will be closer to short-term interest rate in economy. Proxy of that can be return of liquid fund. But the important point over here is here the return will be equal to liquid fund, but with equity taxation. So 7% today, your HNI client who is at in the you can say 30% tax bracket, if he is making 7% return, his post-tax return will go down to as low as 4.5 to 5%. Whereas in arbitrage, if he stays even for 1 month, 2 month, 3 month, which is short term, if he makes 7%, post-tax his return will still be around 6%. So almost 100 to 150 basis point over and above liquid on the post-tax basis, assuming both of them give you similar return. Then also you will have tax arbitrage of almost 100 to 150 basis point. Coming back to equity saving fund, as I told you, because it has 25% naked equity, it is more volatile compared to a pure arbitrage fund because 25% equity can give you good return in a bull market like last year. And at the same time, during the time of COVID, this fund can give you negative return also. If you look at historical return, this is an equity product with a naked equity component. That's why we say you should come at least for 3 years. If you see historical rolling 3 year return of this fund for last 10 years, the lowest 3 year return this fund has given you is around 4.5%. The highest it has given you is around 12.5%. And average rolling 3 year return for last 10 years is close to 8.5%. So arbitrage was giving you return in the range of 6 to 7%. Equity saving fund in last 10 years has given you returns in the range of 8 to 9% on a rolling 3 year basis. After that, there is another category which is known as balance advantage fund. In equity saving, equity is fixed at 25%. In balance advantage fund, equity is dynamic. It can be anywhere between 30% on the lower side and can go up to as high as 80%. Now, depending on different, you can say fund houses, there are different models, different algorithms, which helps them to navigate their equity between 30 to 80%. Historically, again, if you will see, we have this fund from 2009. So 2009 August to 2023 December, we have completed more than 14 years of actual data. Here also, if you look at rolling 3 year return of this fund for last 14 years, that is almost 11 years and 3 months of rolling 3 year returns. The average return is around 10.9%. So you can say 10.5 to 11% is the historical 3 year average rolling return of this fund. And the interesting point is in last 14 years, we have seen 25% correction in Nifty in 2011 because of European crisis. Then we saw in 2013 when India was termed as fragile five at the time of taper tantrum. Nifty corrected by more than 15-20% within a couple of months. In 2016, we saw surgical strike. In 2016, we saw demonetization. Then in 2018, we saw introduction of long-term capital gain tax on equity plus ILFS and DHFL issue. After that, in 2020, we saw COVID, the worst pandemic in last 100 years. After that, we saw Russia-Ukraine war, we saw Israel-Gaza war, we saw US interest rate going down, going up from 50 basis point to all the way to 5%. Even after so many global and domestic events, our balance advantage fund in the last on a rolling 3 year basis till date has never given you negative return even once. Average return, as I told you, is around 10.9%. Lowest it has gone is around 2.2%, and highest it has given you 19% CAGR on a 3 year basis. So again, a very good product for most of our equity investor. It can be a replacement to your traditional large cap oriented category like large cap fund, large and mid cap fund, flexi cap fund, wherein if you look at last 5-7 year returns, returns of this category on for the last 5 and 7 years is between you can say 14 to 17%. Edelweiss Balance Advantage Fund in last 5 to 7 years has given you returns in the range of 12.5 to 13.5%. So return wise, it is as good as your traditional large cap oriented category, but those large cap oriented category has seen a volatility of 16 to 20%, whereas Edelweiss Balance Advantage Fund has delivered almost 90% of the returns with a volatility of almost only 9 to 10%. So almost 40%, 45% lower volatility and 90% similar return. At the same time, all this category in last 5 7 years has seen a drawdown of 35 to 45%. That means your client at one point of time, his portfolio from 10 lakhs would have gone down to 6 lakh, from 1 crore would have gone to 60 lakhs in case of all this large cap oriented category. Whereas in our case, our most unluckiest investor who would have entered at our peak NAV and exited at our bottom NAV would have incurred a loss of less than 15%. So that is how Balance Advantage Fund is a win-win product for all kind of equity investor. Those who are looking for replacement of fixed income also. So we gave you average return of 10.5 to 11% on a rolling 3 year and rolling 5 year basis. And we have given you better risk adjusted return compared to most of your equity product, which are large cap oriented. So definitely one can look at Balance Advantage Fund. After that, we have another category which is known as aggressive hybrid fund, wherein equity can be 80% and that will be remaining 20%. So again, this is a product which has given you better risk adjusted return compared to all your large cap funds for last 5 years, 7 years, because one 20% fixed income gives you consistency, gives you stability whenever markets are down, and remaining 80% equity is good enough to generate better compounding return because they are in a better position to protect your downside. So the whole game of compounding comes into picture, and that's why most of the aggressive hybrid funds are easily able to beat your large cap category. And that's why it is a much better, you can say, replacement to your traditional long only equity product, wherein if you will see last year, which was a good year for equity market, Nifty gave you 20% return, large cap fund gave you around 25 26% return with 100% equity. In the same period, aggressive hybrid fund also gave you 25 to 26% return with only 75 to 80% equity. So that is also another product which one can definitely look at. So these are the product, again, as I told you, from risk reward point of view, arbitrage is for someone who don't want to see even a single negative observation. Your traditional fixed income investor, those who are restricting themselves to FDs or fixed income product. So arbitrage is a product for them. Zero chances of getting negative return on a rolling 1 month, 2 month, 3 month basis. Your upside will be in line with short-term interest rate. Duration, expected duration for investor in this kind of fund will be at least 3 months. It can be 3 months to 1 year, 1.5 year, 2 year also. Then equity saving fund is suitable for those investors who are ready to take some volatility, but want better than, you can say, traditional fixed income return. So normally we say FD plus 2% kind of return if someone is looking at on a post-tax basis, then aggressive hybrid, then equity saving fund is the category. Again, the caveat over here is you have to stay invested at least for 3 years because it is an equity fund. Lower side return will be in line with what your saving accounts give you, 4.5% with equity taxation. On the upper side, it has given you double-digit return of 12.5 to 13% also. So again, suitable for investor who are ready to take some volatility, but expectation is FD plus 2% kind of return. Then the next category is balance advantage fund. It is as good as you can say volatility wise, it is 50% lower, riskier, lower volatility, lower drawdown compared to your traditional equity product. But yes, in a fall like COVID, this has given you negative 14 15% return also. In an environment where Nifty was down almost 40%, mid cap and small cap were down 50%, even this fund was down close to 14.8%. So slightly, you can say, more volatile compared to equity saving fund because of higher equity allocation, but again suitable for those investors who are looking for a replacement of 3 year FD, 5 year FD, 7 year fixed income investment, and are ready to take some volatility but stay invested at least for 3 to 5 years without getting impacted by short-term volatility in market. So this is a product suitable for them. Historical return on a rolling 3 year, 5 year basis is between 10 to 11%. Then aggressive hybrid fund, it is purely a replacement to your traditional equity product like large cap, large and mid cap, flexi cap. Volatility wise, it will be, you can say, two-third of what volatility have a normal long only fund. But return wise, it will almost be 90 to 100% of what returns are delivered over there. So better risk adjusted alternative to your traditional fixed income investment. Again, an equity product. So at least 3 year, we normally guide for 5 year. Stay invested at least for 3 to 5 years, and only then you will get benefit of this category. So Ankit, these are the, you can say, four main funds which are managed by me and my team. The total AUM in this four fund, if you will see, Balance Advantage Fund, Edelweiss Balance Advantage Fund is close to 10,300 crore. Arbitrage fund is close to 8,100 crore. Our aggressive hybrid fund is close to 1,200 crore, and equity saving fund is close to 350 crore. So these are the four products. As I told you, return range is anywhere between 6 to 12.5%. Uh, Risk wise, most of them has not given you negative return on a rolling 3-year basis. Even in the worst fall of COVID, when Nifty was down by almost 38, 39%, even in that period, 3-year returns of all the four categories was positive. So it can definitely be looked upon by your conservative set of investor or even your aggressive investor, particularly today when markets are at lifetime high and people are worried what next, because there is Lok Sabha election coming up. There are Fed policies, there are RBI policies where rate cut and anticipations are on an extremely higher side. And we have a lot of geopolitical issues going on between China, Taiwan, or US, Russia, Ukraine, Israel. So many, you can say, geopolitical tension going on. So it is like we are on a position where markets can easily go up 10-15% if there are interest rate cut, and at the same time market can easily go down 10-15% if the geopolitical issues rises further. So in this time where there is so much of uncertainty, I think the best place to hide is Balance Advantage Fund and other hybrid category. Ankit, I think you are on mute.
Sorry. So to summarize, there are four categories. One is arbitrage, which is zero equity. Then equity saving fund, which is like 20-30% equity. Then there is a balance advantage fund, which can go 20 to 80%, and aggressive hybrid equity, which will always be more than 65% in equity. Correct. And
Perfect.
and commensurate to proportional to equity exposure will be risk and returns.
Yes.
Great. So, Bhavesh, let's take one question from our YouTube viewers. There is one question from Ajit Jain who's asking, what can we expect from the bond markets from now on?
Yeah, I think bond market has taken this, you can say, budget in a very positive way. I think government also is the way this budget is announced. I think government also is moving in direction where they can ask rating agencies to upgrade India's rating, because even after in an election year, if you are not giving a populist budget, that clearly shows a sign of fiscal prudence which this government wants to state. And I think bond market will take it positively as we move ahead in this year. I think JP Morgan bond and index inclusion will also lead to an inflow of almost $20 billion in our fixed income, plus lower borrowing from government. So I think interest rate will definitely go down further from here. And I think it is matter of time where we will start seeing interest rate cut also. Maybe RBI will wait for a signal from Fed, and only after that we will announce our first rate cut. But bond market will look, you can say, at least 3 months, 6 months ahead of time. And I think a rate cut will be factored in much earlier compared to actual announcement by RBI or even actual announcement by Fed. So definitely this is a time to add duration, and definitely you can say mark to market gains can be, you can say, decent. You can get double digit return in fixed income fund for next 3 to 6 months, because I say, as I told you, it is not the matter of, it is not a debate whether there will be a rate cut or not. The only debate is whether it will be in this policy or next policy after that. That is the only thing which is getting debated as of now.
Great. And then we have another question, which is is this a good time to go aggressive and invest in small cap funds, considering the possible movement after elections?
I think small cap fund, if you see, I think it is very difficult to predict because we are into a strong momentum. And this momentum can take away, you can say, small cap funds, small cap index by another 15, 20, 25% easily. Because there are two or three positive events which can happen. First is, as I told you, interest rate cut in US, then interest rate cut in India. After that, I think the way momentum is there with the, you can say, BJP government, I think 2024 Lok Sabha election verdict can also be positive for market, because as of now, market is factoring that government will repeat. There will not be any change, but still that overhang is there until the time of result doesn't come out. That overhang will definitely be there. So once that result is out, I think that can be another tailwind, you can say, for small cap as a sector. But we will be slightly cautious because we have seen that, you can say, one of the best rally in small cap in last many years. And after a rally of, you can say, more than 70-80% or almost, you can say, 100% now, definitely some break, some pause can definitely come, and market will not find look for any reason. Just because simple profit booking, index can go down by 10-15% from these levels. So in that context, we will say invest in small cap in a staggered manner. Don't put all your money together. At least give yourself 6 months or 12 months time to deploy in a slow and steady manner. Valuation wise, though one may can say argue that small caps are trading at a rich valuation or slightly expensive valuation, but I think growth momentum is also strong. If earning momentum is strong, valuation can definitely be taken care of. So that's why it is not a time to, you can say, completely exit small cap. But yes, be slightly cautious for deploying fresh money. If you will see the largest fund in the category stop taking subscription when small cap index was at around 10,500, 11,000. Today, as we speak, small cap index is at new high. It is trading at 16,300, 16,500 odd levels. So if the largest fund in the category was, you can say, has missed almost a 50% rally, and the missed in the sense they stopped taking subscription when index was at around 10,500 to 11,000. So that clearly shows that it is very difficult to predict where the top will be. If the fund has already missed a 50% upside from 11,000 to say 16,000, 16,500, so that risk will be there from here also. 16,500 can easily go to 19,000, 18,000. We don't know, but risk reward as of now will be to be a slightly cautious.
Great. And Bhavesh, so that reminds me, in the month of February 23, we came out with this report about relative valuations of large, mid, and small cap, and we showed that how small cap and mid cap are better placed on valuation side as compared to the large cap. And since then, I think markets have gone by 40% as far as the small cap is concerned. But I think right now it's the other way around. Large cap valuation wise are better placed if you look at long term valuation. We have got another question, which is how do you invest in Edelweiss hybrid, aggressive hybrid fund? Means what is your asset allocation and investment strategy over there?
Yeah. So in Edelweiss aggressive hybrid fund, we run a portfolio wherein 75% is fixed investment in equity and 25% goes into debt. Debt is high quality debt, primarily into T-bill, GSEC, and high quality AAA rated paper. So we have a debt casing policy which clearly states we will not invest in any securities which are even, you can say, AA plus rated. We will invest strictly into AAA rated investment and to GSEC and T-bill for some derivative margin requirement. 75% which goes into equity is more, you can say, like a you can say an aggressive version of, you can say, large cap fund. In large cap, 80% is top 100 market cap company and 20% is other. In aggressive hybrid fund, we run 70% large cap and 30% other. So you can say, when I say other, it is mid cap and small cap. And our investment universe is NSE 500 company. So when I say small cap, it is only 251 to 500 market cap company. We don't go into smaller caps beyond, you can say, top 500 companies of NSE 500. Now, the strategy which we follow is a factor-based investment approach, wherein you will see a lot of AMCs are either valuation-based AMC or growth-based AMC. So historically, we have seen when value as a strategy performs well, like what is happening in last couple of years from the time interest rate hikes have started. Value as a strategy has done extremely well, and those AMCs which are loaded on valuation-based strategy are doing exceptionally well. But 2 years, you can say, if you go back just 2 years ago, all these AMCs which are loaded on valuations were performing, you can say, in a very bad shape. There was an underperformance of almost 5%, 10% compared to the index for most of these, you can say, value-oriented AMCs. At that point of time, growth-oriented AMCs were doing exceptionally well. Now, we don't want to be in a situation where we are dependent on the market cycle, where if growth does well, we will do only well, and then those period, or when valuation does well, we will perform only in those market. We are into a multi-factor approach where we have given weightage to both growth as a factor and valuation as a factor and as the momentum as a factor. So there are different factors on the basis of which we select our equity portfolio. That's why you will find our portfolio will be amongst, we will not be the best performing fund in the category, because when value do good, value based AMC will be the number one fund. And when growth do good, growth based AMC will be number one. But because we follow multi-factor approach, we will always be in top 5, top 7 performing fund. That is Q1, Q2. If there are 40 funds, we will always be in top 10, 15 performing fund, because our intention is, if every time, every year, irrespective growth is doing good or value is doing good, if consistently we are in Q1, Q2, over a long period of time, you will automatically find our funds in top 3, top 5 performing fund in the category. And then that's why we don't want to give you, you can say, shocks of being number one as well as number 40 in a different time period, because A lot of investor looks at last 1 year return and then they decide where to invest. If you look some of the funds which are winner of last 1 year, you invest over there, and then high chances that after 1 year, when you complete 1 year of your investment, that fund will be in the bottom quartile. We don't want to have that kind of, you can say, swing from Q1 to Q4. So that's why internally we target Q1, Q2. We don't want to be rank one because we don't want to take risk to become rank one. There is a risk that you can become rank 40 also in the 40 fund universe. So better to stay in such a way, manage your fund in such a way that you are always in top 10, top 15 performing fund in a 40 fund universe. And automatically over a reasonable period of time, your fund will be in top five performing fund. And that has been the mantra for most of the fund in Edelweiss. And you can see, you look at Edelweiss Balance Advantage Fund, you look at Edelweiss Aggressive Hybrid Fund. For that matter, you look at Edelweiss Mid Cap Fund, Edelweiss Small Cap Fund, Edelweiss Multi Cap Fund. Most of these funds follow a similar strategy. We will not be the number one performing fund, but we will not be the number, you can say, 30th or 40th performing fund also. And over a, you can say, 3 to 5 year time period, you will find most of our funds in Q1 bucket.
Great, great, good to know. Bhavesh, one of the very interesting categories is balanced advantage fund. So where fund manager decides equity allocation as per market valuation, and different fund houses have got different models for them. So I understand that some will have PE as the primary parameter, some may have PB, some may have long-term PE, etc., etc. But without going into the model part, if you could just help our audience understand how this category helps people to surmount volatility of the markets.
Yeah. I think, see, the most important principle on which a balance advantage fund runs is they they factor in that human emotions or human intelligence can always, you can say, play a negative role on performance of a fund. Like, say, for example, if we just take 2 or 3 example in last 3 4 years. The first one was COVID. Lockdown was announced in India on 23rd March. Nifty was at a lower circuit. You can say we saw 7,600 levels on that day. Now, as a human being, what your emotions would tell you that there is a lockdown, there will be nationwide no movement of goods and services and human being. As a result, all earnings will go into, you can say, pitfall. Because if there is no, you can say, movement of goods and service, like who will go to theater, who will go to airplanes, who will go to, you can say, out and do shopping. That means it was like a scenario where earning will go for a toss, and that means market will see a carnage. And that's why we were at 7,600. And if you would have followed your human, you can say, intelligence or human emotions, you would have sold everything on that day and booked your losses. But now see, from that day, we have still date have never seen that levels again, and Nifty is up almost 3 times from those levels of 7,600. Similarly, when US hiked interest rate, they first hiked by 25 basis point, 50 basis point. This was normal. But one fine day on 15th or 16th of June 2022, they came and hiked rate by 75 basis point. Again, your human emotions would have taken over your, you can say, logical decision making sense, and would have told you 75 basis point rate hike in a single day is like a big negative event, and higher interest rate, particularly in US, will lead to liquidity outflow from India, and then our markets will tank. That day Nifty made bottom of 15,200, and today we are up 50% from those levels. So that is where we want to show that whenever you take decisions keeping human emotions in mind, chances are high that you will end up making wrong decision. That's why in balance advantage fund we are running purely a model driven portfolio where model will decide how much equity we have to carry on a day to day basis. Now, the main objective of this fund, again, as I told you, is to win over a long period of time, purely because of the magic of compounding. See, a 100 rupees portfolio, when markets are down 40%, goes down to 60. But 60 to become again 100, there has to be a rally of more than 65%. It will a 40% rally will not suffice to take 60 back to 100. So that is simple maths, or you can say simple compounding. That is where balance advantage fund comes into picture. At the time of large fall, like COVID, Nifty was down by almost 38%. Balance advantage fund restricted your downside to only 14%. So in our case, 100 became 85, whereas in case of your normal equity fund like Nifty or large cap fund, your 100 would have become say 60. Now, in my case, 85 to become 100, I wanted a rally of only 16%. Whereas in those case, to 60 to become 100, they wanted a rally of more than 65%. Finally, rally came, and as a result, Nifty that year ended with 15% return, whereas balance advantage fund in that year ended with 23% return. So that is, you can say, one small example which what a balance advantage fund wants to achieve over a long period of time. So we have seen last 5 years, 7 year, 10-year return of Nifty are almost equal to 90%. So balance advantage fund has been able to deliver almost 90 to 100% of what a long only equity product would have delivered, but with 50% lower volatility and almost 50 to 60% lower drawdown. See, in India, if you stay invested for long term, definitely you will make money. You buy anything, you will make money if you stay invested for 3 year, 5 year, 7 year. But in that 5 year, 7 year period, there will be multiple period where your portfolio will be down by 15, 20, 30%. And that is the most trickiest time where even those investors who come with a 5 year, 10 year, 20-year view, but suddenly see their portfolio is down by 20, 30%, their human emotions take over their logical decision making sense. And as a result, they try to, you can say, move out of the market at the wrong time. Balance advantage fund just wants to help you to navigate through this volatile period and give you better risk adjusted return over a long period of time. And as I told you, it has been able to deliver returns which are almost equal to Nifty over a last 5 year, 10-year period with much better, you can say, risk profile, 50% lower volatility and almost 60% lower drawdown.
So in long term, you can say कि in a balanced advantage category, we get returns which are comparable to large cap with lesser volatility. Correct?
Yes, yes. So it is almost 90%, 95% of large cap return with just 45 to 50% volatility.
Okay, Bhavesh, during our research now, we were working on why Indian markets are still so stable. Well, world over markets are suffering. Indian markets are still very stable. We got to know three, four reasons for it. One is obviously SIP. So for last 1 year, the amount of SIP is almost equal to money taken out by FIIs. Second was NPS. Third was EPFO. So EPFO is investing 5% of the incremental money that they are getting into markets, and they can take it up to 15%. One very pleasant surprise was this category only, balance advantage funds. And how it worked, ki whenever market came down, and I am sure as a fund manager you will agree to it, as soon as market comes down, they divert money from debt to equity. So that also becomes a source of money for equity markets, more so when markets are not doing good. So do you think for the stability of the markets, this category has can potentially contribute more in future?
Definitely. So today you will see balance advantage finance category is almost at 2,50,000 crore. Even now, because valuations, if you see on historical basis, are slightly expensive. Even now, the average equity of balance advantage fund is close to 50%. The largest fund is at 40%. Some of the funds are at 50, 55%. So average will be around 50%. So a 2,50,000 crore category sitting on net equity of 50, maximum we can go is 80. So 30% is equal to 75,000 crore. That means 75,000 crore worth liquidity is already there with balance advantage fund managers, which are waiting for right valuations to deploy that money into the market. So as and when there will be correction, this 75,000 crore worth liquidity right now, which is sitting in arbitrage or sitting in any fixed income instrument, is supposed to be in equity. But as I told you, this will provide cushion to market on the downside. So similarly, there are different, you can say, SIP monies which we are getting, EPFO money which is coming into the market. At the same time, a lot of long only equity product also like large cap, mid cap, small cap. All these fund managers are also sitting on 5 to 7% cash, again waiting for right opportunity to invest. So I think any fall in market, it will be like a buy and dip kind of market at least for near future, unless there is some unexpected event which you can say happen. Most of the risk is known to the market. Any unwanted or you can say any unknown risk can definitely trigger correction. But I think amongst the all the known risk there will be you can say huge amount of money sitting on sideways waiting for deploying in any dip. And that's why you will see in last 3 4 months whenever we have seen sharp fall of 300 400 500 points in a day, immediately in next 3 4 days that correction has been taken over and markets have moved to new high. And then I think this trend will continue unless there is some, you can say, unknown shock which can derail this journey. But I think a lot of liquidity on sideways will make sure that we don't see a large cut in market.
Great. And Bhavesh, now that markets have appreciated quite significantly in last 1 year, which categories do you think can be good, good allocation for next 1 year or 2 years?
I think, as I told you, next 1 year is full of, you can say, a lot of global and domestic event, starting from RBI policy, Fed policy, then India Lok Sabha election, after that US election. So there are more than, you can say, 25 to 30 countries which will go into election in next 1 year. So all these things will definitely lead to a lot of volatility. So in US, so again, there are, you can say, chances of Trump coming back. In the US, again, there are chances that we may see interest rate cut sooner than later. So at the same time, as I told you, there are a lot of geopolitical issues which are going on. Yeah, what we have seen in last few days between you can say US, Europe, US and European partners doing on Iran, Iraq, and Syria, that can also escalate. Russia, Ukraine is going on. Israel, Gaza is going on. So there are so many geopolitical issues which can also add to volatility. So I think for next 1.5, 2 year, volatility is here to stay, and the best way to navigate this volatility will be through you can say lump sum investment in hybrid fund and staggered investment in the form of SIPs and STPs into your long only products like mid cap, small cap, and you can say even large cap. If you are you can say positive on India story with the 5 to 10 year view, I think mid cap and small cap are still attractive. But after a decent run up of last 1.5 year, I think the better way to play over there will be doing some profit booking and then again putting money in the form of SIP and STP over there. And then for lump sum investment, you have balanced advantage fund, you have equity saving fund, you have aggressive hybrid fund to look at.
So I'll share one anecdote over here. So we started in the month of December 22. Means Wealthy Nivesh we started in the month of December 22. And from
Okay.
December 22 to April 23, market had a V-shaped kind of recovery. So it went down and then it came up. So those who invested lump sum in December, in April, they were sitting at 0% gain. But we always had this staggered approach, even for lump sum investment through STP, weekly STP. So our clients were sitting at 15% gain. And we were covered by ABP News also for the same.
Yeah.
So I think it makes a lot of sense that not only where you are investing makes sense, but how you are investing, at what frequency you are investing also makes a lot of sense.
Yes. Yes.
Great. Thank you, Bhavesh. It's a pleasure talking to you. The kind of insights that you brought to the discussion were very enlightening. Thanks for the discussion, and we look forward to having more of such sessions with you.
Sure. Thanks, Ankit, for giving us this opportunity. For any further details, please get in touch with our team. We are more than happy to, you can say, arrange such call on a frequent basis. Thank you.
Great.